Good afternoon, everyone. I am CA Payal Chauhan, the moderator of the webinar. We are delighted to welcome you all to the webinar, which is being organized by Continuing Professional Education Committee of ICAI. CPE Committee has organized a series of webinars for the benefit of member at large. Starting from today, which is 6th October 2025 till 17th October 2025 from 12 p.m. to 2 p.m. We request all to kindly block your calendar for the same. It's my pleasure to be the moderator of the webinar on recent amendment in Form 3CD, including Clause 22 and 26, and non-compliance in accounting standards. In a short while we start the webinar, first I would like to appraise you about the CPE committee. In today's ever-changing professional scenario worldwide, the biggest challenge the professional face is how to stay on the top of their game while adapting the new requirement and norms. Therefore, it is imperative to aim to be up to date and offer unique guidance and influence other with their innovative approach and expertise. It is also vital to stretch old ideas beyond tradition boundary to create new perspectives. In this context, continuing professional education facilitates professional to maintain, improve, and broaden their knowledge, skill, expertise required to achieve the professional goal through webinars and seminars. The program for the afternoon is as follows. We have two sessions of 1 hour each. The first session will be on recent amendment in Form 3CD, including Clause 22 and 26, followed by the second session, which is Common Non-Compliance in Accounting Standards. Our eminent speakers will talk about the above mentioned two emerging areas of professional interest in short. But before that, I'll welcome our chairman, Sir CA Satish Gupta, Sir, who is presently serving as the chairman of Continuing Professional Education Committee of the Institute of Chartered Accountant of India. In addition to this role, he is a chairman of UDIN Directorate and the vice chairman of the Committee of Member of Practice for the current term. He previously served as a council member of ICAI from 2019 to 2022. He is a renowned speaker and an author specializing in income tax assessment, searches, surveys, and professional development topic like goal setting and career planning. So, sir, with due respect, I welcome you to the webinar.
Thank you, Payal. Thanks a lot.
Thank you, sir.
And my dear friend, a very renowned faculty on the audit part, and I know him since long. And whenever we find some problem in the audit quality or audit standard, we look towards Kamal Garg. He is from Delhi, and I can assure you that his deliberations are going to add a very good value as far as tax audit is concerned. And he is taking today clause 22 and 26. Both are very important clauses, and clause 22 is the problem for every chartered accountant. So I would request Kamal Bhai to deliver that how can we make easy clause 22 at least for our members. And Payal, who hails from my city, my state, and doing great in the field of education of various aspects of chartered accountancy, very proactive. Ginni Secretary, CP Committee, delivering a very nice, very active, and very performing a great was job here. Team CP, Team Tech, who is broadcasting this particular session, and my dear members who are attending this webinar. As rightly stated by Payal, that the very purpose to organize this special series on tax audit, standards on auditing and accounting standard was to keep update our members what new is there, what is needed to refresh. And since it is audit month, we are going to complete the tax audits at least in this month. So I think the deliberations will definitely take them a mile ahead. So this was the very purpose, but this is in addition to our regular webinars of Wednesday and Fridays, which we hold 4 to 6 p.m. So I would request members that I know that you are busy in the tax audits, but listen today and that another 9 days at least for our experts. And I can assure you that you will definitely add values in tax audit and other audits. So friends, with this, I would also like to bring some informations about the Institute of Chartered Accountants of India at the ICI. We are all are 32, with all 32 council members are working hard under the dynamic leadership of our president and vice president. And believe me, friends, at CP, where I'm heading, we are going to bring a new CP portal, which will take care that the members get CP credit on real-time attendance basis. Meaning thereby, if a member attend a program for 4 hours only out of registered for 12 hours, he or she will get credit of 4 hours only. So this we are going to bring, I think, hopefully October end or November, uh, 1st or November 2nd, we will be launching the new portal developed by the TCS, and we will definitely ensure that we give quality and the availability of CP programs for our members, even to the members who are in the deepest corner, yeah, I can say very far corner of the country. We are opening as many as CP chapters, CP groups, and as many as CP circles for the benefit of our members to ensure the availability of the CP programs. Apart from this, friends, this year we have taken lead to some initiatives in UDIN Directorate also, where we have ensured that no member would be in position to generate 61st UDIN in respect of tax audit. We are also asking the auditor's opinion from our members about their report, just simply asking whether they have um, clean report or the modified report. If the report is modified, whether there is a adverse opinion or qualified opinion or a disclaimer. Or even in the case of corporate entity, whether there is KYM or there is some EOM or the other matter reporting. So we just want to know, we are not asking for the details of that qualification or the disclaimer. We are simply asking whether you have qualified the report, yes or no, whether you have disclaimer, yes or no, nothing else. So, and this is just for the research purposes for the institute, that whenever it is needed, that how can we improve the quality of audits, how can we reach to the government about our members' work in case of audit? So this is the only purpose. Research purpose is the only thing. So we are this particular figures, the informations will be encrypted and will not be disclosed even to the verifiers. Apart from this, friends, we are enabling our members to know the name of succeeding auditor in case of an auditee who leaves the auditor and go to the new auditor, but the previous auditor is not in position to the name of succeeding auditor. So with the help of technology, the UDIN Directorate will tell the name of the succeeding auditor. I'm also Vice Chairman of the CP committee, and Honorable President has given me responsibility to bring some new benefits to our members. So, friend, just to brief you that we have arranged one term loan from SDFC Bank, very unsecured loan, no collateral at the rate of 10.60%, reducing interest only. And I think this is very competitive rate when we see the market. Although I know no chartered accountant in need of the money, but I had previous experience. When I was the council member, we made arrangement with the Poonawalla Finance. Then more than 200 crores loans were taken by the members in the period of 3 months only. So it is just a facility. But if you need for any purpose, you can go for SDFC. We have also arranged the working capital loan from the SDFC at the rate of 11.60%. And we are going to bring one of the new credit card for our members from a private bank. And there are good features available, lifetime free, no renewal, no joining fees. And apart from this, airport lounges are also available. And the credit card company is going to provide 25% discount to our members for any 1 year on the renewal fees payable to ICI. Suppose I am to pay rupees 8,000 my renewal fee to the ICI as a member, so I will get the 2,000 rupees discount paid by the credit card company. So we are just thinking that how we can make some new things also. We are in touch with the Adobe, we are in touch with the Google, Meta, OpenAI, just to bring several benefits for our members. We are also in touch with the chain of the hospitals of our cities, where we can arrange several benefits for members. Just for describing you, friends, we have one arrangement with the Medanta Medicity Delhi. I'm very surprised to see that only 500 odd members have taken that benefit, very big benefit, friends. That Medanta Medicity is providing 15% discount even on the surgeries, even on the hospital's stay. So that becomes a very big amount, in particular in this age when the bill of the hospital comes in the lakhs of rupees. So if you don't have the insurance coverage, even if you have the coverage, then particular that discount is available. So we are working in that particular group to bring several other initiatives for the benefit of our members. So just wait that how can we bring some more things for our members. Apart from this, friends, we have launched this year very good course, very visionary course, rather, I would say, the dispute mechanism on the GST. This is a 6-day course, friends, where we are training the members, and rather in a workshop format, how can we deal with the GST litigation. So these are the some things which I wanted to talk you. Otherwise, there are several things which I can talk, but at later time we will discuss, because it is the time of the Kamal Bhai, and you also want to listen him. You also want to listen how to deal with the class 22 and class 26 in the first part, and thereafter our Vishal Bhai, who is the council member and doing very great, big work in the council as far as the forensic account auditing is concerned, audit standards, accounting standards. He is very cooperative also. Whenever anybody talks him, he is always ready for the help. So I think both the speakers will make you a new auditor. I can believe me, new auditor today. So all the best to all the members who are attending this webinar, and thanks from my deepest heart, my dear Kamal Bhai, for giving your valuable time, and dear Payal for our giving a good time to the committee and to the ICI. Thanks a lot. Thank you very much. I am at present
you,
at
sir.
Goa in a family function, so I would not be able to live in continuously in the entire session. But thank you very much. Thanks a lot. All the best. Enjoy it. Thank you.
Thank you
Thanks.
so much,
Sorry
sir.
for leaving.
So that was CA Satish, sir. And thank you very much, sir, for such a thoughts and the wisdom. Now, I am honored to welcome our first speaker, CA Kamal Garg, sir, who is a FCA and DISA, MCOM and insolvency professional with expertise in corporate law, audit, and management consultancy, backed with extensive industrial experience. He is regular faculty and a guest speaker at ICAI and ICSI seminar webinar with international exposure, including a session for the National Board of Accountant and Auditor, Tanzania. He is author of multiple professional books on IFRS, Audit, Companies Act, and IBC, published by reputed publishers like Walter Kluner and Bharat Law House. So, sir, I welcome you to start with the session.
Thank you, Payalji, for this warm introduction. I believe I am audible to all of you. Payalji, am I audible?
Yes, sir, perfectly.
Thank you. I'm thankful to CPE committee also and Satish Bhai for giving me this opportunity and the vice chairperson as well. Before I share my screen and discuss the topic in detail, the topic for the day is recent amendments and the words used are including clause 22 and clause 26. So I will touch upon the other amendments as well. But yes, quite obviously, clause 22 and 26 in detail with some numerical illustration so that things becomes easy. So I am sharing my screen. Just give me a moment. Payalji, I believe my screen is visible.
So it's not. Yes, sir. Now, sir, kindly take it on the full mode.
It's on full mode already.
Sir, now perfectly, sir. Done.
Okay. So topic for the day is tax audit recent amendments, including clause 22 and clause 26. Not taking much of the time in all other things. Let me start with Form 3CD straight away. The audience may recall that recently the Institute of Chartered Accountants of India has also issued guidance note on tax audit, which was revised 2025 edition. So I have also incorporated those revisions in my PPT today. So what happened? We need to understand what exactly is Form 3CD. The Form 3CD requires you to Form 3CD requires you to report about true and correct view. And that's why Form 3CD is titled as Statement of Particulars, which need to be certified to report as to whether the particulars are true and correct. And true and correct needs to be distinguished from true and fair view. In a way, 3CD is a kind of absolute assurance, not reasonable assurance per se. The Statement of Particulars, as we call Form 3CD, needs to be attached to the reports in Form 3CA and 3CB. You know very well when Form 3C and 3CB are applicable, so I will not go into details of 3C. Part B, Part A comprises of Clause 1 to Clause 8A, and Part B comprises of Clauses 9A to 44. And today our discussion will be confined to recent amendments, whatever happened in March 2025. In particular, in totality, there were 9 amendments. We'll discuss those 9 amendments one by one gradually. So these are the 9 amendments. If you see on the screen, these are bulleted over here, 1 to 9. These 9 clauses were either amended or omitted or inserted by virtue of March 28, 2025 notification. You can see on the screen, notification number 23/2025. And these amendments are applicable for this tax period. And these amendments being applicable this tax period, we need to be careful about the new ways of drafting our management representation letter, the new ways of documentation as well. So I will touch base those issues as well. Now, guidance note on tax audit 2025 edition, what it says in respect of Form 3CD, what we need to understand, the prime responsibility about Form 3CD is of the assessee. And that's why the guidance note states, as a tax auditor, you have to obtain from the assessee. You have to obtain from the assessee the statement of particulars in Form 3CD duly authenticated by the assessee. So it's my tip to all of you that you have to comply guidance note on tax audit and its recommendations being made. Whenever you obtain Form 3CD, please have authentication from the assessee also. That is what the guidance note warrants. Guidance note further says, if a particular item of income or expenditure, as the case may be, is covered in more than one of the specified clauses in Form 3CD, a suitable cross-referencing is also required. How this cross-referencing will take place, I will touch base when I will discuss upon clause number 22 and 26 in detail. If any particular clause in Form 3CD is not applicable, it should not be left blank. The tax auditor should state not applicable against that clause. If tax auditor relies upon a judicial pronouncement or a precedence, he may mention the same in Form 3CA or 3CB as the case may be, in particular para 3 of Form 3CA and para 5 of Form 3CB as the case may be. Please understand, when we say para number 3 of Form 3CA and para number 5 of Form 3CB, the audience may recall in Form 3CB we have para 1, 2, 3, 4 and 5. Let me ask you a question. If there is a possibility to answer, please try to answer. Else I will ask questions to Payal because I am able to see Payal only. What is the distinction between para 3 of Form 3CB and para 5 of Form 3CB? So if audience is not replying, then Payal will reply.
No, audience can't reply. I'll be asking the question from their side to you.
Okay. So let me spill the beans. Para number 3 of Form 3CB pertains to books of accounts and financial statements. And para number 5 of Form 3CB deals about Form 3CD. So we have to be very careful where we are reporting. So whatever cross-referencing is there vis-a-vis Form 3CD, please take a note of it that para number 5 of Form 3CB is the appropriate place. The guidance note further says, because there can be difference of opinion or difference of understanding or interpretation between the client and the tax auditor, then what to do? For this purpose, the guidance note suggested if there is any difference in opinion of tax auditor and that of the assessee in respect of any information furnished in Form 3CD, both viewpoints should be stated by the tax auditor along with the relevant information related to that matter. So this will help the tax authorities to take a decision in appropriate way. And more importantly, I must emphasize with greater strength, the accounting standards or Indian accounting standards, the guidance notes, the auditing standards, that is SA, issued by institute from time to time should be followed. Now, why this is important? When you draft your tax audit report in Form 3C or 3CB, my experience had been that the population is not following the guidance note on special purpose reports and certificates. So because the time is limited with me and this topic is not regarding that guidance note, so I would suggest you, whenever time permits, download from ICAI website the guidance note on special purpose reports and certificates and incorporate the elements of that reporting in Form 3CA and 3CB respectively. And if it is not so done, it will be a professional misconduct under Chartered Accountants Act. So we have to be very careful. Now, if I come to the amendments, as I told you, there are total 9 amendments, beginning with clause number 12. Clause number 12 is a very cosmetic amendment. The audience may recall, like 44 BBC section was introduced. This 44 BBC deals with special provisions for computing profits and gains of business of operation of cruise ships in case of non-residents. So in that very sense, what happened, the Form 3CD was amended and this 44 BBC was inserted over here. In my personal understanding, even if CBDT had not inserted this 44 BBC, that doesn't make any difference, because if you see this red letter, any other relevant section, so these words, any other relevant section, they by default were covering all those sections which are entailing presumptive taxation schemes. But yes, now we have a specific insertion of 44 BBC, so it's a kind of, I would say, a cosmetic change, not a substantial change. Then comes clause number 19. Now clause number 19 says reporting of amounts admissible under various sections. So these are the list of sections, 32AC, 32AD and so on. Second column is dealing with amounts debited to P&L and third column is dealing with amounts admissible as per provisions of the Income Tax Act and also fulfills the conditions, if any, specified under the law. Law here means the income tax law. Now what happened is clause number 19 was having a good list of various sections dealing with amounts debited to P&L account and admissibility thereto. Some of these sections became redundant over time because of amendments being carried out in Income Tax Act gradually. So what happened? These amendments took place. So from this big list, these 4 sections are now omitted. Section 32AC, 32AD, 35AC and 35CCB. These 4 sections are no longer required to be reported. Again, in my personal understanding, I must say, had these sections not been omitted, that will not take away the sanctity of Form 3CD. Why? Because even now, if we come to this tax audit period, these sections have no role to play, because these sections even now are no longer applicable to this current previous year. Now, other one is clause number 21. In clause number 21, you may recall section 37 is reportable for various items like capital expenditure, personal expenditure, club expenditure. So big list is again there. In that very big list, this paragraph is inserted, reporting about expenditure incurred to settle proceedings initiated in relation to contravention under such law as may be notified by central government. So this change was introduced in Form 3CD on account of the amendment which was made by Finance Act 2022 in section 37, subsection 1, explanation 3, clause 4. Now, what happened of late, the government of India notified this law. That is, just see. So on 23rd April 2025, central government notified that if you paid any amount to have a settlement of any contravention under these four laws, SEBI Act, Securities Contract Regulation Act, Depositories Act, and Competition Act. So if any amount is being paid for settlement of proceedings under these four or any of these four notified laws, that expenditure is disallowable under the law, and that expenditure is reportable under this new insertion. What is this new insertion? The new insertion is about expenditure incurred to settle proceedings initiated in relation to contravention under such law as notified by central government. So what is this law? Total four laws are there: SEBI, SCRA, Competition, and Depositories. In my personal understanding, if this kind of client is there, it would be rarest of the rare client in most of the CA fraternity per se. But yes, if it is not applicable in your client's case, please do not forget to mention not applicable. If you recall, the guidance note also stated, I am going back for a while, the guidance note also stated that if nothing is applicable, then you have to state not applicable. So in that very sense, if I come to clause 21, suppose that you have a client, but if that client has not incurred any such expenditure, then please do mention not applicable or fill 0 at least. Now comes the superhero of Form 3CD, the most talked about clause number 22, and then we will discuss upon clause number 26 as well. The audience may mark my words that clause 22 and clause 26 are interrelated in a greater way. But that doesn't mean, I emphasize, that doesn't mean that clause 22 has no connection with other clauses of Form 3CD. So I am leaving a question just now, which I will answer after a few moments. The question is whether clause 22 has connection, has interplay only with clause 26, or clause 22 may have interconnection or interplay with other clauses of Form 3CD as well. So we'll discuss this question after some moments. Let me first discuss in brief and then in detail through an example what clause 22 is entailing for this previous year 24-25. So people, what happened if you go in a pre-amended era, clause 22 was worded like this. So this is pre-amendment version. Amount of interest inadmissible under section 23 of Micro, Small and Medium Enterprises Development Act. I emphasize again, amount of interest inadmissible under section 23 of MSME Act 2006, or this or any amount not allowable under clause H of section 43B of Income Tax Act. This or till 1961, these words were inserted in the last year. You may recall the Form 3CD was amended last year also. Now what happened post amendment for this previous year, these initial words, amount of interest inadmissible under section 23 of Micro, Small and Medium Enterprises Development Act, these words are retained as it is. These words are retained as it is in clause 22, but this has been numbered as clause 22 subclause 1. Now these two subclauses are new additions to clause 22. What this clause 22 second says? Reportability about total amount required to be paid to a micro or small enterprise as referred to in section 15 of MSME Act during the previous year. Please focus these words during the previous year. This is very important. Then number third, of the amount referred to in second above. That means clause third is having interconnection with clause number second, or I should say subclause second. Now what subclause number 3 requires? Of the amount referred to in second above, amount A and B paid up to time given under section 15 of MSME Act, and number second, not paid up to time given under section 15 of MSME Act. Now in my personal experience recently, the population is reading this number B up till here only, MSME Act, and they are getting oblivion of the other words and inadmissible for previous year. What I am trying to convey, in this third B, you have to report not only that amount which is not paid within time, but you have to report those amounts which are not paid within time, and the word and is crucial, and these amounts are also inadmissible for the previous year 24-25. Now a question may arise, What is the meaning of word inadmissible? Whether inadmissible under any section of the Act or inadmissible only under section 43BH of the Income Tax Act. For this purpose, Guidance Note on Tax Audit 2025 edition has already clarified the word inadmissible here shall be presumed that this is nothing but section 43BH. That means, say for example, the amount paid in time is rupees 100. Amount not paid in time is rupees 50. Entire 50 rupees will not be reportable here. Out of that rupees 50, what you will do, you will analyze and check out of rupees 50, what is that amount which is getting disallowed under section 43BH. That will get reportable here. The story is not so simple. Let me raise few questions before the house. The words used are Micro, Small and Medium Enterprises Development Act. But here the words used are paid to a micro or small enterprise. Medium enterprise is not covered. Why? Medium enterprise is not covered because the benefit of delayed payment of interest is not available to medium enterprise. Why? Because medium enterprise is not considered as supplier. I repeat, medium enterprise is not considered as supplier under MSME Act. So what you need to remember, here only micro small enterprises dues will be captured. Dues towards medium enterprise will not be captured. Second point, by virtue of July 2021 Office Memorandum of Ministry of MSME, read with the second memorandum in September 2021 of Ministry of MSME, the trading enterprises are also allowed to obtain Udyam certificate. A question arises if there are some outstanding dues towards trading enterprises and this trading enterprise is registered as micro enterprise, whether it will be considered for this reporting or not. Answer is no. That office memorandum already clarified. The trading enterprises are allowed to obtain Udyam certificate, but only for the limited purposes of, I emphasize, only for the limited purposes of priority sector lending. That means for a banking industry, if a trading enterprise is having Udyam certificate, then it will get a benefit of priority sector lending status. Else, trading enterprise, despite having Udyam certification, will not be considered as micro or small enterprise for the purpose of MSME Act. That we need to be very careful. For example, you have an SSC and that SSC purchased, let us say, paints or raw material from a local shop who is a trader, and that local shop trading shop is registered with MSME as a micro enterprise, and the amount is outstanding on 31st March. Whether you will apply the interpolation of clause 22, answer is no. Why? Because that local shop, being a trading enterprise, is considered as micro enterprise only for the purpose of priority sector lending, not for your purpose. That we need to be very careful. So what is the learning? Learning number one, medium enterprise will not be captured for the purpose of clause 22 second. Secondly, trading enterprise also will not be captured for the purpose of clause 22 second. Now, having said that, let us take one illustration. I give you 30 seconds and then try to answer what will happen. So this is the small illustration to make you understand how this clause 22 will be reported. So we have total 5 suppliers. Like you can see 1, 2, 3, 4, 5. Supplier name is A1 Tools Limited, so micro enterprise. Beta Electric Works, small enterprise. Gamma Fasteners, micro enterprise. Delta Supplies, small enterprise. Epsilon Company, micro enterprise. You can see very carefully, none of these enterprises are medium enterprise. So I have done one job for you, that micro, small already are identified. Invoice date is also given to you. Acceptance date is also given to you. Now, acceptance date is important because acceptance date will be helpful to define the due date. Now, what is due date? Section 15 of MSME Act says due date shall be defined in this manner. If written agreement is there with the vendor, then what will happen? The payment timeline or the due date is as per the agreement defined period, but this agreement defined period cannot go beyond 45 days. If there is no agreement, then due date will be 15 days from acceptance. Keeping these two things in mind, the job is also done by me. I have already given you no agreement or 45 days, and due date is also given. So due date is also given to you. Payment date is also given to you. This payment date is crucial. That for this invoice, payment was made on 30th April 2025, but how much payment was made? Only 40%. Total invoice amount is also given to you. Now you need to first of all answer me whether the amount is paid in time or not. Interest is also computed by me. So these figures are computed. Hypothetically, these are the interest figures. So first of all, the question is, which of the amount is paid in time or not? Number one. And number second, which of these amounts are reportable in clause number 22 post amendment? I give you 30 seconds because I have a very few minutes left with me for the first half session. If you see carefully, let me spill the beans again. If you see carefully, total invoices are 5 as per this table. Total amount of invoices 10 lakh rupees, 1 lakh plus 2 lakh plus 3 lakhs plus 1,50,000 and 2 lakh. Total is 10 lakh. Now let us check what is the amount paid in time or not. Now, paid in time here means not as per section 43B, but as per MSMED Act section 15. Paid in time. Whether this amount is paid in time? Yes. Whether this amount is paid in time? No. Whether this amount is paid in time? No. Whether this amount is paid in time? Yes. Whether this amount is paid in time? No. So I have done this job for you also. Now take next 10 seconds and prepare answers in your mind. You have all the working papers ready with you. This is the kind of working paper you have to prepare. Now out of this working paper, which amount will travel into clause 22 and which amount will not travel into clause 22? So just have a look out. Just see very carefully. First one is clause 22(1). What clause 22(1) was saying? Amount of interest inadmissible under section 23 of MSMED Act. Total interest amount is 24,700. How this is coming? Just see. Add up these interest components. Total amount will be 24,700. But clause 22 second was requiring total amount required to be paid to a micro or small enterprise as referred to in section 15 during the previous year. What is total amount required to be paid during the previous year? This is the total amount required to be paid during the previous year. So this will come up here as 10 lakh rupees. Now what was the clause 22's third requirement? Out of this 10 lakhs, what is the amount which is paid up to the time given by the law and not paid up to the time given by the law plus inadmissible for the previous year? So what is the amount paid in time? Amount paid in time is 1 lakh and this 1,50,000. So this is 2,50,000. Not paid up to time and inadmissible. Let us go back again. These are 3 yellow rows, and these 3 yellow rows are saying, they're telling the same story almost, that this amount is not paid in time. But we have to be careful. Out of these 3 amounts, can you please check what is that amount that is also inadmissible under section 43BH of Income Tax Act, because only that amount is reportable in clause 22(3)(b). If you see carefully, this 2 lakh rupees of amount was paid on 30th April 2025 and that to 40%. So this amount is paid after 31st March 2025. Because this amount is paid after 31st March 2025, this becomes inadmissible for the previous year ending on 31st March 2025. If you see this 3 lakh rupees, this amount, although is not paid in time, but on account of section 43BH requirement, this amount still is allowable amount because this amount is paid within the previous year. Are you getting my point? And then is this 2,50,000. Although this amount is not paid in time as per MSMED Act, but this amount still is allowable under section 43BH because this amount is paid within the previous year itself. So what will happen? Out of these 3 yellow rows, amount not paid in time in totality is 2 lakh plus 3 lakhs plus 2,50,000. That is 7,50,000 rupees. But the question is, are we supposed to report entire 7,50,000 rupees? Answer is no. The correct answer is only 2 lakh rupees. So this 2 lakh rupees is the amount which is not paid in time plus is also inadmissible under section 43BH. I believe this point must be clear to all of you. The story is not that simple again. The question arises, what will happen to this 2 lakh rupees? Now this 2 lakh rupees will be opening balance in the next year's Form 3 CD. And that is what clause 26A is dealing with. Just see here. Clause 26. Prior to amendment, clause 26 was asking you to report in respect of any sum referred to in clause A, B, C, D, E, F, or G of section 43B, the liability for which pre-existed on first day of previous year but was not allowed in the assessment of any preceding previous year and was paid during the previous year but not paid during the previous year. And number B, was incurred in the previous year and was paid on before the due date of ITR and not paid. If you see minutely what happened post amendment, earlier this 26 number clause was not dealing with section 43BH. Now what happened post amendment? All these clauses A, B, C, D, E, F, G are omitted. So entire section 43B is covered. Entire section 43B is covered in the initial words. And what they're asking, in respect of any sum referred to in section 43B, the liability for which pre-existed on first day of the previous year but was not allowable. The word is allowable. Earlier it was not allowed. Not allowable in the assessment of any preceding previous year and was paid during the previous year, not paid during the previous year. Now one more amendment took place. Earlier this capital clause B was dealing with section 43B A to G. But now what happened? In this post-amendment scenario, this capital clause B has specifically stated for clauses other than clause H of section 43B. That means what you need to take a note, section 43BH. Section 43BH is the scope of clause 26 capital A, but is not the scope of clause 26 capital B. Now just see very carefully. What will happen to this 2 lakh rupees? What will happen to this 2 lakh rupees? This 2 lakh rupees will travel to next year's Form 3 CD. Why next year Form 3 CD? Because this 2 lakh rupees is not allowable in the previous year 24-25. And what the question was saying, 40% is paid in 25-26. So it will become paid during the previous year and not paid during the previous year. So how this will look out? Just see. For the previous year 25-26, this 2 lakh rupees will be reportable in clause 26 capital in this manner. Paid during the previous year 80,000. How this 80,000 is coming? The question was telling you, no? 40% is paid on 30th April. So 40% 2 lakh is 80,000 rupees. This 80,000 rupees will come in 26A clause A, paid during the previous year 80,000, not paid during the previous year 1,20,000. Total will be 2 lakh. So now, as chartered accountants, you have to prepare this working paper. Now, how you will prepare, that is your lookout. But yes, this working paper or working papers capturing this kind of a theme will be a must in this post-amendment era regarding clause 22 and clause 26. The story is not over. So don't think that clause 22 and clause 26 are completed. You may remember, I asked you a question whether clause number 22 is having any interplay with any other clauses of Form 3 CD also. That was also my question. The answer is yes. Answer is yes. Now let us discuss interplay of clause 22 versus clause 26 versus section 43BH. So I will discuss this thing in detail. Now what this interplay is all about? Clause 22 deals with MSME reporting based on MSME Act. So MSME classification will be as per MSME Act. Now what this classification is, I will discuss in a while. What the guidance note says, this clause number 22 is introduced to report payments due to micro and small enterprises under MSME Act. It requires the disclosure of three things: interest inadmissible under section 23 of MSME Act, total payments required to be made to MSMEs under section 15 of MSME Act, and payments made within time and not within time as per MSME Act. Clause 22 3B, which we just have covered, focus on amount not paid within time prescribed under section 15 of MSME Act and hence inadmissible under section 43BH. This we have already covered. Now what does clause 26 says? Clause 26 deals with section 43B reporting. Clause 26 capital A. It captures the liabilities under section 43B pre-existing on first day of the previous year and whether they were paid or not in the current year. Then it also deals and includes section 43BH because it's tracking previous year disallowances regardless of the clause type. What clause 26 capital B deals with? It deals with current year liabilities. It explicitly excludes section 43BH from its scope because section 43BH has distinct payment timing requirement. Because you may recall, section 43BH timing requirement is not tied with the ITR due date, but is tied with MSMED Act due dates. So what is the conclusion? 43BH is only tracked in clause 22 and clause 26A and not in clause 26B. Next, this is something very, very important. Interplay with other clauses. So question arises, reporting with respect to sections 30 to 37(1), 40, 40A for MSME payments. The point is, if a payment to micro or small enterprise fails the test of section 30 to 37(1), say the payment was not wholly and exclusively for business or is disallowed under section 40 or 40A, for example, it was a cash payment of more than 10,000 rupees or payment was made to a relative, then what will happen? Then it will be inadmissible under these respective sections regardless of section 43BH. Clause 21 of Form 3CD. Clause 21, I repeat and emphasize, clause 21 of Form 3CD is the right place to report such general disallowances under these sections. Clause 22 and clause 26, which I just have covered, focus specifically on timing disallowances due to late payments under section 43BH. So what is the conclusion coming up? Even if an MSME payment is timely under MSMED Act and hence allowed under section 43BH, it may still be disallowed under other provisions and hence they need to be captured and reported accordingly in Form 3CD. In particular, it will be clause number 21. Further, if payments to micro or small enterprises are not made within the time limit prescribed under section 15 of MSMED Act, such payments must be reported, as I told you earlier also, clause 23, clause 22, third B, as they are delayed. However, if these payments were actually made on or before 31st March 2025, they will still be allowed as deduction under section 43BH in assessment year 2026. So we have already covered all this agenda. So the reporting in clause 22 is not to employ disallowance, but to ensure disclosure of non-compliance with MSMED payment timelines. Additionally, very careful. Additionally, interest on such delayed payments, which is inadmissible under section 23 of MSMED Act, must also be reported in clause 22 first. So we have already covered this whole scenario of clause 22, 1, 2, and 3. More importantly, the guidance note on tax audit 2025 edition also states there is no question of reporting any amounts disallowable under section 43BH in respect of such assessees under clause 22 or clause 26 who are following cash basis of accounting. Why? Because they will anyway claim deductions for such amounts on actual payment basis only. Interest on delayed payments to MSMEs payable under section 16 of MSMED Act will be liable to be disallowed under section 23 of MSMED Act only when these are debited to P&L account on cash basis in the year of payment. So if you have a client who follows cash basis of accounting, you have to be very particular about this guidance. The guidance what further says, which I already covered in the numerical illustration, the amount inadmissible as per clause 26A3, I mean the amount inadmissible as per subclause 3. Which subclause 3 we are talking about? Clause 22. For a financial year would be the opening balance. I already covered this figure. Opening balance in the subsequent financial year for the purpose of reporting clause 26 capital A, that is any sum referred to in section 43BH which pre-existed on the first day of the previous year but was not allowed in the assessment of any preceding previous year. Now, what we need to understand, this is what the guidance note says. In addition to this, I would suggest the audience to take note of few things. There could be information deficiency which you may come across during the course of tax audit. So if complete information regarding MSME dues is not available while reporting under clause 22 of Form 3CD, the tax auditor should adopt the following approach. Number one is obtain MRL, that is management representation letter. So we have auditing standard number 580. That guidance needs to be followed over here. What the guidance says in SA 520, the auditor should request a detailed representation from the management confirming the following. Number one, identification of creditors falling under the definition of micro or small enterprises under MSME Act. Number second, amounts outstanding and delays, if any, beyond the period specified under Section 15 of MSME Act. And lastly, interest liability under Section 16 of MSME Act, if applicable. So you have to obtain MRL for these components. More importantly, you have to disclose the limitations clearly. So when I say limitations, we have Form 3CA and Form 3CB. But in particular, if I come to Form 3CB, para number 3, what you have to do? If despite best efforts, full information is not available, the auditor should report what has been obtained based on the available records and management representations and make a specific disclosure in the observation paragraph of Form 3CA or clause number 3 of Form 3CB indicating the non-availability or limitations of information. Documentation, as I was telling you already also, maintain adequate working papers, including correspondence with the management and any alternative procedure performed to determine MSME status or outstanding dues. And lastly, the approach should be use reasonable judgment. The auditor should apply professional skepticism and consider whether supporting evidence such as confirmations, registration certificates under MSME Act, payment terms in contracts, etc., are available or not. So this is the guidance which I believe is as per applicable auditing standards. Now I have few very quick questions. The audience may recall from 1st April 2025, I emphasize this date. From 1st April 2025, the thresholds for classifying micro, small, and medium enterprises were revised. I repeat, from 1st April 2025, the thresholds for classifying micro and small enterprises, they were revised. You may see on the screen the revised thresholds. Earlier, it was current investment 1 crore, which was revised to 2.5 crores. Turnover limits were also revised from current 5 crores to 10 crores in case of micro, and then respectively for small and medium as well. My question to the House is, these limits were revised from 1st April 2025, and we have to furnish audit report for the year ending on 31st March 2025. So when you will be reporting under clause 22, whether you will consider the revised limits or the previous year limits. You know, I believe, or rather I should correct myself, I am skeptical for one more point. The audit will be carried out in this September or August period, as the case may be. So it may happen that the supplier may furnish that he is a small enterprise or a micro enterprise as per the revised threshold. So the enterprise which might had been, let us say medium enterprise in the preceding year, because of revised threshold may become small enterprise or vice versa like that. The question arises, they may give you confirmation that I am a, for example, micro enterprise, but in fact, it was not micro enterprise as per the pre-revised limits. So what to do? The auditors must be very careful. The auditors must be very careful that MSME status for the year ending on 31st March 2025 shall be evaluated only on the basis of prior, or I should say pre-revision thresholds. So pre-revision thresholds needs to be evaluated. Be very careful, because the other party, being the vendor, they may say that they are micro or small enterprise, but they may not be. So you have to be very careful to check what limits they are applying. And for this purpose, you may take external confirmations as well. The guidance note further says, it is the responsibility of auditee and not that of the auditor to classify and identify those suppliers who are covered by Section 2, Clause N of MSME Act. Primarily, auditee will tell you, and you will obviously evaluate whether the assessee is right or wrong about micro enterprise classification and small enterprise classification or medium enterprise classification. You may recall clause 22(1), what it was dealing with. It was dealing with interest disallowable under Section 23 of MSME Act. So what I am trying to say, the guidance note also echoes the same sentiments. According to Section 23 of MSME Act, the amount of interest payable or paid to any buyer under Section 16, that is thrice the bank rate for delayed payment, shall not, for the purpose of computation of income under income tax rate, be allowed as deduction. Now the question is, don't be in a hasty mode when you will report this interest, please also check whether TDS on this interest, whether TDS on this interest is deducted or not. Just see the last sentence. Verify that TDS under section 194A is deducted from interest credited or paid to MSMEs and deposited with central government. And this cross-referencing will travel into clause 34 of Form 3CD. So we have to be very careful whether this interest being provided is also made subject to TDS or not. Supreme Court delivered a judgment in Silk Industries case whereby Supreme Court said to seek the benefit under MSME Act, the seller should have registered under the provisions of the Act as on the date of entering into the contract. In any event, for the supplies pursuant to contract made before registration of the unit under the provisions of MSME Act, no benefit can be sought by such entity as contemplated under MSME Act. So you have to be careful as tax auditors to check whether the status of MSME is based prior to entering into the contract or post entering into the contract, depending upon the judgment given by Supreme Court. More importantly, the tax auditor needs to report the amount of interest inadmissible under Section 23 of MSME Act, irrespective of whether the amount of such interest has been debited to P&L account or not. This is something very, very important. I have seen some of the assessees are not making provision of interest payable under Section 23 and 16 of MSME Act. It's a contravention of Accounting Standard 29 as well as Ind AS 37, as the case may be. So if interest is payable by virtue of Section 16 of MSME Act, as per Accounting Standard 29 or Ind AS 37, as the case may be, provision for interest payable needs to be provided for in the financial statements. And if this provision is not made, it also warrants a qualification. It also warrants a qualification in Form 3CA or 3CB, as the case may be. More importantly, even if this provision for interest is not provided for in the books of accounts, still the tax auditors have to report in clause 22(1) what is the amount of interest inadmissible. Now the point is, if auditors are not able to report this thing, they have to give the limitation. They have to give the limitation that why they're not able to report the same, where in Form 3CB, para number 3. So I believe the audience must have a very fair understanding of clause 22 and clause 26. Before I wrap up this session, let me ask you a very quick question. The quick question is, you may see on the screen, interplay with other sections. Whether the cross-referencing is required, answer is yes. Cross-referencing is required, and this cross-referencing should also have a mention in Form 3C or 3CB, as the case may be. So now 2 or 3 clauses are also left out. Let me cover those clauses also. So other amendments are clause 28 and clause 29, dealing with income or other source income in section 56(2)(7)(a) and 56(2)(7)(b). So these clauses are omitted. No longer reporting is required, and that's why these clauses need not be looked into. Then we have clause 31 Form 3CD. Clause 31 Form 3CD is having total 8 sub-clauses dealing with section 269 SS and 269 ST. So there is no big change over here. A cosmetic but important amendment is there now, but the amendment says the codes are assigned. So with effect from this 1st for 2025, the major change has been introduced in clause 31 to enhance the accuracy of loan and deposit reporting. How they have enhanced it, a notable addition is made to have the introduction of drop-down selection feature, which allows taxpayers to specify the exact nature of loan and deposit transactions more effectively. If I show you, this is a drop-down list. Then you will fill in Form 3CD, you will find this drop-down list. If you see, total 12 items are there, and in these 12 items, for respective nature of amount, they have given the codes also. So you have to choose the appropriate codification. Question is whether interest-free loan need to be reported in clause 31. Answer is yes. Interest-free loan needs to be reported in clause 31. Judgment is also there from Mumbai Tribunal in Chandrakant S. Shah case. Now, if you are tax auditor of a company, you must have noticed certain entries are book entries. So if the loan is being given or squared off by book entry, whether it needs to be captured, answer is yes. So guidance note on tax audit also says the loans and deposits taken or accepted by transfer entries in the books of accounts constitute acceptance of deposits or loan otherwise than by account pay checks. So this also needs to be reported. And if you are the statutory of a company or you are the tax auditor of a company and somebody else is statutory of a company, please also go through the stat audit report. Why I'm saying in statutory audit, we have companies that being applicable. In companies that we have section number 143(1)(b). In section number 143(1)(b), the statutory auditors are required to inquire whether any transactions are represented merely by book entries. So you have to cross verify these things. And lastly, we have clause 36B. It's a newly introduced clause, and this deals with the buyback. So buyback deemed dividend. So what this clause says, very simple clause, whether the assessee has received. So the word is received. So assessee may have followed accrual basis, but here it is cash basis. Has received any amount for buyback of shares as referred to in section 2, clause 22F. And then if yes, the amount is received, then what you have to furnish? The amount received and the cost of acquisition of such shares being bought back. So it's a self-explanatory clause. I believe no further explanation is required, but I must tell you one thing. What this clause is requiring you to report about the amount received and cost of acquisition. They're not asking you to compute anything like capital gain or cost of, let us say, cost of any loss in the preceding years, post amendment, and so on. Three simple things only. Amount received, yes or no. If the answer is yes, what is the amount received? And number third, what was the cost of acquisition of such shares being bought back? Be very careful. The word here uses share, not securities. The word here uses share, not securities. But once you go to Companies Act, in Companies Act, it is the buyback of securities. So there could be a scenario that the buyback of securities has taken place. The question arises whether buyback of securities is reportable here or not. This could be a divergent view of various professionals, but in my understanding, keeping the whole spirit of this clause, even buyback of securities must be reported. But yes, different of views can be there. So from my side, this is the content which I attempted to cover within the given time frame. And I'm really glad that I listened all the lecture while being quite visible on the screen.
Thank you, sir.
From my side, this is the discussion. I will be
Thank you, Kamal, sir. And that was really wonderful session. And we people, everyone, I'm thanking you from behalf of every member who joined the webinar, that we've been enlightened and we have actually experienced so much of more knowledge about section 15 of MSME Act and the various income tax sections. And thank you very much, sir.
Namaskar, Vishal ji.
Namaskar, Kamal ji. Thank you very much.
Thank you, sir. Thank you.
I was hearing your presentation, really insightful. Thanks a lot.
Now, I'll to all the members, I'll welcome our second guest, Sir C.A. Vishal Doshi, sir, and he'll be taking a webinar on common non-compliance on accounting standard. Before Sir start the webinar, let me introduce Sir to everyone. He's presently serving as a second-term Central Council member of the Institute of Chartered Accountant of India, and is also a member of International Auditing Assurance Standard Board for term 2024 to 2026. He leads the audit and assurance practice of the firm at Vadodara and has over 25 years of experience with expertise in audit of listed, government and multinational companies, as well as on Ind AS, IFRS, convergence and implementation. He is a chairman of Financial Reporting Review Board, vice chairman of Accounting Standard Board, and deputy convener of Center for Audit Quality Directorate for the term 2025 to 2026. Having earlier held several key leadership roles at ICAI, WIRC, and its branches. He have delivered numerous technical sessions on Ind AS, IFRS, auditing standard, ethics, practice management across ICAI platform and academic institutes, and has been a visiting faculty at MS University, Vadodara. So here I welcome you, sir. And for the today's session, we have 200 plus members joining and waiting for your. Thank you, sir.
Thank you. Thanks very much, Payal, for that kind introduction. Very good afternoon to all the participants who have joined this webinar, this initiative of the CPE committee. So I would like to compliment the chairman, Satish Gupta ji, and the vice chairman, Vishnu Agarwal ji, who have stitched together on this webinar series. And definitely, we heard Kamalji on the tax audit clauses, quite insightful. And the responsibility that has been entrusted to me is the commonly observed non-compliances on the accounting standards. And friends, I would like to share here that being the chairman of the Financial Reporting Review Board, like Payal also mentioned in my introduction, this is the second year, and where we do a lot of reviews of the financial statements, where we come across the non-compliances with respect to the accounting standards, as well as the Ind AS. We have also come out with publications on this commonly found non-compliances, which can be downloaded from the Financial Report Review Board portal. So there are 3 volumes of the non-compliances with respect to the AS and 3 volumes with respect to the Ind AS. So what I would be today doing is that the team at FRRB has picked up some of the non-compliances or the observations, I would say, that the Financial Report Review Board has come across in the course of its reviews of financial statements, and we'll take you through some of the observations, but covering a large number of the accounting standards. So it would not be a single accounting standard specific, but a large number of accounting standards that I would be covering in my presentation today. Right. So I presume my screen is visible very much.
Yes, sir.
Yeah.
Perfectly.
So, like I said, that this presentation has been stitched together by the Financial Report Review Board, the team at the FRRB, and we'll start with the non-compliances with respect to AS1, with respect to disclosure of accounting policies. So, in one of the financials that the board reviewed, the accounting policy was stated that the unrealized loss on the outstanding derivative contracts had not been recognized in the books, considering the principles of prudence. So here I would like to share, friends, that what the observation was, that one, the policy itself is incorrect, because considering prudence, the unrealized loss has to be recognized in the books. And why we have picked this up is members would agree, participants would agree, that nowadays a lot of our clients are actually dealing in the derivatives, futures and options. And therefore, this becomes a very important observation from an accounting point of view also. And let me tell you, my experience is that we need to take care, especially on the cutoff procedures, the year-end procedures, with respect to the open contracts that are there in the futures and options. Because normally there is a tendency as auditors that we say that the balance in the books of the broker, the client's ledger in the broker's book, should match with my audited financials, that is the broker's balance that is appearing in the client's financial statements. Debit credit cross mein, what we typically say. But that might not hold true in all the cases, especially in the mark to market transactions that happen when there are open contracts at the year end. So let us take a situation that a client has, I would say, invested in a futures contract which is open as on 31st of March. And there is a loss, a mark to market loss, because you would understand that daily, as per the stock exchange guidelines, the losses or gains, whatever are the closing rate, they are debited or credited to the client's ledger by the broker, and be accordingly monitored. So as on 31st March, the open contract, there was a loss overall, and that has been debited to the client's ledger in the broker's book. Since it is a loss as per AS1, that has to be recognized. The mark to market loss has to be recognized. And in this situation, the balances between the two ledgers would match. However, let us take a situation that if there is a mark-to-market gain, in such a case, as per considering the principles of prudence, as per AS1, the gain will be ignored for the accounting purposes, and therefore this gain would not be recognized in the financial statements that are audited by the chartered accountants, and therefore to this extent there would be a reconciliation between the two balances. So that is why we took this up, because this is something very important. And let me tell you, friends, that my experience is that the mark to market accounting for futures is relatively easier as compared to options. So please understand the correct positioning of the gains and losses with respect to the F&O, or for that matter, any other derivative contracts that would be there outstanding as on 31st of March or at the financial year end. Moving on, the second observation, or this is a general observation overall, that what we have found at the FRRB is that disclosure of significant accounting policies are not given with respect to certain category of transactions or balances that are appearing in the financial statements, like borrowing costs. Again, there is an impression that members feel that borrowing cost policy is to be given only when there is a capitalization that happens under AS 16. Let me tell you, friends, borrowing cost, if you see the definition, borrowing cost means any interest expense or borrowing related expenses, processing charges, fees that are there, everything would form part of the borrowing cost. And therefore, whenever there is any borrowing cost, as per the definition of AS 16, the policy has to be given. The disclosure of the significant accounting policies as to when would the entity capitalize the borrowing cost, that should feature in the significant accounting policies, right? So like I said, in almost all these cases, we have found that there are related transactions or balances, but the policy is not appearing, and therefore this becomes an observation or a non-compliance as far as the standards are concerned, the accounting standards. Second is again valuation of inventories. The policy on the valuation of inventories will go to further detail on certain aspects, but in general, the policies on valuation of inventories was missing, though there might be a closing balance of the inventories, or even there are transactions of purchase and sales, specifically with respect to trading companies. There are transactions of purchase and sales. They may not be having a closing inventory, but the valuation of inventory policy was missing. So this also we need to take care. Similarly, accounting in a few cases where investment transactions buy sell are there, or even when there are closing balances, and many times what happens is that there are no such transactions or balances in the previous year. However, in the current year there are transactions and balances. However, because of we take the template of the last year's financial statements of that client, there are chances that certain policies are missed out in spite of there being transactions in the current year, because they are not there in this previous year and they get missed out. So this is one thing that we need to take care, that whatever are the transactions in the current year, they should be mapped and ensure that the corresponding policy is there. For employee benefits also, there are a lot of, many times we find that there are some disclosures given in the notes to accounts, but the policy is missing. So again, wherever there are employees, friends, take it as a thumb rule, the policy on employee benefit should be there, because there would be short-term employee benefits also. So it's not necessary that only if leave and gratuity are applicable that you would have to disclose the policy on the employee benefits. As long, because employee benefits also cover short-term employee benefits, long-term employee benefits, and then you have the termination benefits also. So all these come under employee benefits, and therefore even if you have one employee, the policy on employee benefits should be there. Again, coming to next, accounting for taxes on income. The thought process here is that if there is deferred tax, then I need to give this policy. If we look at the standard taxes on income, it covers two type of taxes. One is the current tax and second is the deferred tax. So current tax is typically the provision for tax that we do for the current year, and deferred tax, as we all know, is because of the timing differences that would arise. So even if there is no deferred tax, but there would be a provision for tax, typically in the case of the small companies, in case of LLPs, in case of partnership firms, and therefore the policy on accounting for taxes on income should be given. Impairment of assets. Again, as long as there is a property, plant, equipment, there has to be a policy on impairment, because it is not necessary that impairment would happen every year as far as accounting is concerned, but as a matter of policy, that when would the entity impair assets. See, if you look at the policies that are there, when would an entity impair assets? So you would test the assets for some of the impairment conditions, and if they are satisfied, then the impairment testing would happen, and then after the impairment testing would happen, if there is an impairment loss, then that would be booked. So this is the process that is there. But first you have to see that whether there are fixed assets, whether there are property, plant and equipment. Yes, then the policy on impairment of assets should be there. It is not necessary that impairment should be accounted for, or there has to be an amount of impairment to give this policy. And last but not the least, on the provisions, contingent liabilities and contingent assets, it is important to note that again, these policies, these are some standard policies, because wherever you have a provision, you have a contingent liability as a part of your disclosure, as a part of your accounting, the related policy has to be given in the financial statement. So these are some of the areas where the board has found that there have been deficiencies in disclosure of the significant accounting policies under AS1. Moving on to AS2, if we see the fundamental valuation, the concept is the cost or net realizable value, whichever is lower. Now, if we look at the left of the screen, there are different observations. So these are all similar related observations clubbed into one slide. So if you can see, there are different languages that are being used in the financial statements by the entities for the purpose of valuation of inventories. So if you see there where they are saying that they are valued at cost, they are valued at direct raw material cost, they are valued at average cost, valued at raw material cost, estimated cost basis, cost comprises all. So if you see from this, there is no clarity which is given that whether net realizable value has been considered in these cases or not, and also that whether it is the cost or NRV, whichever is lower, funda has been applied in such case. And this might result, if we give a policy like this and this is how the valuation is done, this might result into a financial statements not being true and fair, because that might impact the valuation of inventories. If the NRV in some cases is found to be lower than cost, then definitely we have to value at the net realizable value, and if that is not done, that might impact our opinion also. So please ensure that the policy is as per AS2 and the valuation is as per the policy, which is cost or NRV, whichever is lower. On inventories, again, where we have to give the cost formula, that is weighted average or the first in, first out. There are two examples which have been given where it's, I'll read that out, that cost is determined on weighted average, first in, first out basis as considered appropriate by the company. In the second, it says cost of inventories is computed on weighted average FIFO basis. So if you see, these are generic statements that have been given. If we look at AS2, the requirement is that, yes, cost formula has been given in these cases, but cost formula has to be given class of inventory wise. That is raw material, packing material, finished goods, work in process, goods in transit. You would have stores and spares. So these would be the different class of inventories. And for each class, the cost formula has to be given. It cannot be clubbed and given in a general way. Right, so you have to say like raw materials at weighted average cost, or first in first out, packing material at weighted average, or first in first out, depending on what it is. So you will have to give it on the class wise and not a general policy statement. So that is a non-compliance with the accounting standard. Moving on to AS3, cash flow statements. So in the note on administrative and other expenses, we have observed an unrealized exchange fluctuation net that was mentioned in the P&L side on the administrative expenses. But when we go to the cash flow statement, there was no adjustment with respect to this unrealized exchange fluctuation. So please note that in the cash flow statement, It's the cash in, cash out basis sort of a thing that has to be shown as part of your operating activities. So unrealized foreign exchange gain is an entry which is done for AS11, the mark to market, as we may say, as on 31st of March. But that is not actual realization that has happened. So to the extent of such unrealized exchange fluctuation, that adjustment in the cash flow is also required to be done, which has to be ensured. So we have to ensure all non-cash items or non-cash transactions or entries which are non-cash nature gets adjusted in the cash flow statement. So that accounting would be right that you would have to consider the provisions and everything. But as far as the non-cash items or elements are concerned, you have to make adjustment in the cash flow. Again, in the next observation on the cash flow, that there were cash and bank balances which are in foreign currencies that had been given. However, there was no adjustment or reconciliation that was shown for the exchange rate difference thereon. See, we all know under AS11 that for the monetary items, there is a year-end restatement that has to be done. So if the entity, let us say, is holding $1,000 in foreign currency as on 31st March, let us say 2024, and it was valued at the closing rate as on 31st March 24. And then there is a maybe that same amount is continued as on 31st March 25 of $1,000, but still due to the exchange rate difference, there has to be some adjustment that would appear in the financial statements where there are balances in foreign currencies. So this was not observed in this case of the financial statement that the board had reviewed. So that was a non-compliance that was observed. Interest net had been reported for a cash flow from financing activities. So if we look at para 30 of AS3, the interest received and interest paid, it has to be disclosed separately under the cash flow from investing activities. So as far as interest received is concerned, it has to be shown as cash flow from investing activities, and interest paid and cash flow from financing activities. So we cannot show interest as a net amount in the cash flow statement. They have to be shown separately. Again, some of these non-cash items are there, or rather I would say these are the balances which are not readily available as cash and cash equivalent. So though as per Schedule 3, the classification would happen in cash and bank balances. However, as per AS3, they may not be cash and cash equivalent, and therefore, in the cash flow statement, the necessary adjustment has to be done in the balances of the cash and cash equivalent that we show as part of the cash flow statement. So some of those balances, if you see, again, this is a general observation. So like earmark balance against LC, letter of credit, gratuity and superannuation account, unpaid dividend account, interest accrued on fixed deposit. So if you look, all these components are typically something which is not readily available in cash or cash equivalent when we want, when the entity would want. And therefore, that has to be shown as an adjustment and cannot be considered as cash and cash equivalent for the purposes of cash flow. Again, non-cash items, like I was saying, provision for doubtful debts, advances written off, unrealized foreign exchange gain or loss. These are all non-cash item, and everybody would appreciate because there is no transaction of cash or bank that happens in such cases. And therefore, these have to be shown as an adjustment to the cash flow statement whenever it is prepared. So provision for doubtful debts, because that is just a journal entry that we pass. For the provision advance write-off, again, there is no amount that received, and because amount is not received, they are written off. And these are all non-cash items that have to be shown separately adjusted in the cash flow statement. In case of a non-financial enterprise, again, increase decrease in the long-term loans and advances has been adjusted as working capital changes under cash flow from operating activities. So any increase decrease in the long-term loans and advances, it is not from the operating activities. They are investing activities, long-term loans and advances, and therefore it should be classified as changes in the or cash flow from investing activities and not from the operating activity. You'll find a lot of observations on cash flow because that is an area where there are maybe as professionals also we need to spend more time on, like we do for the balance sheet, PL notes and other disclosures. Cash flow is also an area, and therefore a lot of observations are there on the cash flow. So the cash and cash equivalents as reported in the notes to accounts, that means which is forming part of the balance sheet. and the cash flow statement, they do not tally, and a reconciliation was also not given. So whatever we have as the cash and cash equivalent shown as part of the notes to the balance sheet, that amount and the amount, the closing balance that we show, or the opening and closing, both are shown as part of the cash flow statement. They should match, and if they are not matching, then a reconciliation should be given, or actually it should be readily visible that, let us say, in the cash and cash equivalent, if you have a balance which is not easily realizable, and that adjustment is done for the cash flow purposes, and that should be given as part of the reconciliation in the cash flow, that what is there in the notes and what is considered in the cash flow, this is the reason for the difference. Fixed assets lost due to robbery. Again, this is a non-cash item. There would be no money coming in or going out there, and therefore this has to be considered as an adjustment in the cash flow from operations. So now moving on, after the cash flow, moving on to the next, that is the contingencies and events occurring after the balance sheet date. So in one of the notes to accounts, it was given as a policy that the impact of any significant event that occurs after the balance sheet date, but before the finalization of accounts. Now, friends, finalization of accounts is a very I would say generic term, which we do use on a day-to-day basis with our clients, with our team and everyone. However, technically, what do we mean by finalization of accounts? Finalization of accounts is not one date. It would be a range of dates or a period of 5 days, 10 days, whatever it is. Therefore, the right language, and technically, you need to, when we talk about events occurring after balance sheet date, there has to be a specific cutoff. It cannot be a generic date that would be there, and therefore the right term that should have been used is that the date when the financial statements have been approved by the board of directors, unless the date of signing the auditor's report is same as the date of the finalization of accounts. So the date when the board of directors approves the financial statements, that date is to be considered for the purpose of events occurring after balance sheet date. And as auditors, we also need to keep this in mind, that if any event has taken place, maybe just a day before the board meeting, then also if it is a non-adjusting event, then the necessary disclosure has to be incorporated in the financial statements, which would be approved by the board of directors, let us say maybe within a day or two of that event taking place. So that cutoff date, that nomenclature, the wordings has to be very precise. Construction contracts, AS7. So the policy that was mentioned in the financial statement was that job work revenue is accounted on the base of running bills and approved by the clients. Revenue expenditure is accounted on accrual basis as and when it is incurred. So if we see AS7 categorically says that we have to follow the percentage of completion method. Now, when we say revenue accounted on the basis of the running bills, RA bills that are set and approved by the clients. Now, what is the percentage of completion that gets accounted over here? So if we see that it may not be commensurate or coinciding with the actual POCM, because all the expenses are accounted on accrual basis. So whatever expenses till 31st March have been incurred, they are accounted, but corresponding revenue is not being recognized, and therefore there would be a gap as far as the matching concept that we have all studied during our CA exam days. That matching concept would be vitiated, would not be met. And therefore, yes, you may have the bills raised and approved, but then you will also have to consider the year-end procedures. That is, you may have to show some unbilled revenue if the risk and rewards have transferred, but the due date of raising an invoice has not happened. Or you may also consider having a contract work in progress, or the inventory that we would say, to match the costs with the revenue or the inventory. So such a policy is technically incorrect, and like in this case, it would also impact the true and fair view, because it most probably in these cases the revenue would be understated, profits would be understated, whereas the costs would have been accounted for fully, and therefore it would impact the true and fair view of the financial statements also. So in this case, again under AS7, the company engaged in the construction business includes job in progress under note on inventory, but has not made the disclosure. So if you look at AS7, para 39, for all those participants who are there, who are having clients into construction contracts and following AS7, there are certain disclosures which are required to be made additionally. I would say whatever you have accounted for, yes, but in addition to that, the aggregate amount of costs incurred and recognized profits, less recognized losses up to the reporting date, the amount of advances received, and the amount of retention. So you would have that in the financial statements, but if they are not clearly visible, then the additional disclosure, a note should be given to comply with the requirements of para 39 of AS7. Moving on to AS9, revenue recognition. So in this case, this is a case of online educational services, where the policy was mentioned that it is the revenue is recognized upon receipt of subscription fee in case non-refundable, otherwise apportioned over the subscription period. So what happens, friends, is that this is a case where upfront fees are paid, let us say for 12 months, and these are non-refundable, and therefore in this case the entity has recognized the full revenue when the money is received. We would all appreciate that over the 12 months, the related costs would be apportioned over 12 months or as and when they are incurred, whereas the revenue comes as a bullet in the single installment. Now, see, this would be the case in many other such transactions. Like if we say, our the DTH bills that we have, where we all go for these schemes. I would say the OTT platform, where we pay may not be on a monthly basis, but we pay for 11 months and we get 12 months of subscription. 1 month is free. So in all these cases, see, it is very clear that the revenue has to be apportioned over time. Even though if it is non-refundable, you cannot take, because the related costs would be incurred over 12 months, and for the revenue also has to be incurred over the period of 12 months. So you cannot recognize, even though it is non-refundable, you cannot say that since it is non-refundable, the whole amount we would be accounting for when we received the money, irrespective of the time period. So this has to be apportioned over a period of time under AS9. Dividend income. So in some cases, what has been observed is that in the significant accounting policy, it is mentioned dividend is accounted as and when received. Now, this is again technically incorrect under AS9, because AS9 says that dividend should be recognized or accounted for when the right to receive dividend is established. Right? Now, again, I'll break up into two parts. One is the interim dividend, one is the final dividend, because under the Companies Act, the compliances, the processes are different for both. Under interim dividend, once the board declares the dividend, then it becomes due and the right to receive is established. Definitely, there would be that book closure date for listed companies and also once that is over, then the right to receive dividend is established. So you will have to see on cutoff procedures as part of 31st of March that, or typically we as auditors also look into the statement, bank statement of the month of April to find that whether there are any transactions of income or expense or receipt or payment which might be pertaining to the period of March. So in these cases, you should actually go through the month of the April bank statement and see whether any dividend is received and check technically that whether as on 31st March, the right to receive dividend, especially when it is interim dividend, is established as on 31st of March, then on 31st March itself, you should show it as a dividend receivable, though the dividend might have been received in the month of April. When we come to the final dividend, in final dividend, as we all know that in the notes, we have to give that particular disclosure, what is the dividend that is proposed. But the final dividend becomes due only after approval of the members in the annual general meeting, right? So that is where the difference would come between interim and final dividend. So final dividend, if your client has invested in listed companies and where there is a final dividend which is received in the month of September post the AGM, then it is fine that you will have to recognize that in September. You can't recognize final dividend as on 31st of March, though it would be there in the financial statements of that listed company, what the board has proposed. But technically, because it becomes due after the AGM approval, then only it would be accounted for. So you have to be very clear as to when the right to receive the payment or receive the dividend is established and account for it accordingly. Again, some observations, some instances about the accounting policies by different companies. So you can see 3 bullets. So revenue is recognized when no significant uncertainty as to measurability or collectability exists. Revenue, income, and costing are accounted for on accrual basis. Sales are accounted for on dispatch of goods. So in all these three, it is not clear as to whether the significant risk and rewards that are associated with the ownership of goods, they stand transfer to the buyer or the receiver or not. Right? If you see in first case also, there is no mention about transfer of significant risk and reward. In the second and third also, right? So on accrual basis, it's a very generic term. But when we talk of AS9, sale of products, specifically sale of goods, or even sale of services, when the significant risk and rewards have been transferred, that is where the revenue is to be accounted for, and that should be very clearly mentioned in the significant accounting policies. Again, a very typical case, especially rare, but yes, when it happens, there is always a dilemma for the client as well as the auditors when to account the assets lost by fire. So because the insurance claim is by itself a process where in case there is a fire or floods that have happened, there would be a survey that would be happening, there would be a preliminary report that would be submitted, maybe there would be a preliminary assessment that would be happening, and then what would be then there would be a final claim and all those things. So it's a process by itself. So when to account for the insurance receivable, typically in the financial statements. So insurance, so typically it does not meet the definition of revenue because it is not in the normal course of business that I would be earning or getting the money from insurance. So it does not form a part of a definition of revenue. However, insurance claim at the time of filing of the claim, when there is an uncertainty in measurability, is not appropriate, right? So there has to be some confirmation from the part of the insurance company as to the amount of claim that they feel would be paid. There might be still pendency, there might be some litigation also that might happen with respect to the claim, but till the certainty in amount is not established, the insurance claim cannot be recognized in the financial statements, right? So what would happen is, typically in the year when the loss has happened, there would be a reduction in profit because the claim may not be measured with certainty, and therefore the loss with respect to the fire or the flood or whatever calamity would have to be booked in year 1, and in year 2 or maybe year 3 also, once the insurance claim amount is certain, the amount that is receivable or received from insurance company would get accounted for. So definitely there would be a difference in the financial year that the two events would be recognized. So again, revenue from advertisement and ticket sales. So in this case, revenue from sale of tickets is recognized when the tickets have been sold. So again, friends, like I would say, and this would be applicable even if we think about it, that with the movie tickets or maybe even airline tickets, we would be booking maybe in the month of January or February for travel, in the maybe April, May, or maybe summer holidays, we would be booking far in advance in the month of February. So for the airlines companies, they have received the money from us as we have booked the flight or the journey. However, the flight would take place in the month of, let us say, April or May, and therefore the revenue cannot be recognized till that flight or that event has taken place, and till that point in time, it has to be shown as an advance. So this policy is incorrect, and this would also have an impact on the true and fair view because this is preponement of revenue as in the books of account. Similarly, advertisement revenue is recognized when advertisements and net realization are confirmed. Again, advertisements would be happening over a period of time. There might be different ways in which advertisements would happen. So you will have to see the financial year, the financial period, the date when the advertisement would be released, and the corresponding revenue has to be booked in that period when the advertisement would be released, though the money would have been received in advance. So please ensure the same concept, same funda of a matching concept. costs incurred, corresponding revenue booked. Till that point in time, if revenue has been received in advance, it would be shown as an advance and not as in my P&L as a revenue. On foreign currency, so moving on, AS 11, the policy states that current assets and liabilities at the year end are translated at the exchange rate prevailing on the balance sheet date. So there is a difference. AS 11 talks about monetary and non-monetary assets and liabilities, whereas normally we say current assets and current liabilities. So there is a difference between the two. Though in normal parlance we may feel that it's same, but I would give a very simple example of the difference. Let us say for import of goods, there is an advance that has been given to the foreign party. Now, against that advance, I would not be receiving cash or cash equivalent, I would be receiving goods. And therefore, such advance, it would not be a monetary asset, though it may be a current asset. And therefore, such advance would not be restated as at the closing rate for the as a balance sheet date, right? So you have to be very clear about the difference between current, non-current or current assets, liabilities and monetary assets and liabilities, and only monetary assets and liabilities are to be restated. So moving on to the next one, where the policy states that the foreign currency monetary items have been recognized at contracted rates as those are covered by forward contracts. Again, we need to be very clear, forward contracts are different and translation of monetary items are different. So it might be that yes, the forward contracts have an underlying of a monetary item. I mean to say a forward contract might be having an underlying of a trade receivable for the purpose of the contract. But that does not mean that the trade receivable would be restated at the contracted rate. They are two different elements. So the trade receivable would be as per the 31st March closing rate, which they follow, and the forward contract on that would be as per the contracted rate. So both are different. We can't have the trade receivable being recognized at the contracted rate. They are two different elements and have to be separately, the mark to market, or you can say the restatement has to be done separately. Moving on to AS 13. So the company had made long-term investments in equity capital of a subsidiary, which was representing almost 78% of the total capital of that subsidiary. The director's report stated that the net worth has been fully eroded of the subsidiary and there is no scope for any business. However, no provision for diminution in the investment has been made in this case. So if we see that where the director's report itself is stating that the net worth has been fully eroded and no provision has been made, is technically incorrect. It is not in accordance with the AS 13, the accounting standard on that. And again, like I said, this case also the true and fair view would be something that would be impacted. Current investments have been classified as quoted investments. However, market value of the same has not been disclosed. So there is a disclosure requirement under AS 13 to give the market value of all the quoted investments. So you are making under accounting standard, you're following the historical cost method, unlike Ind AS where you do the fair valuation. So since you're following the historical cost method, there is a requirement to disclose the market value of the quoted investments, which was missing in some cases. Moving on to AS 15, employee benefits. The amount of expense for defined contribution were not disclosed by the enterprises. So defined, like I said, there are defined benefit plans, there are defined contribution plans, and there are disclosures that are required under AS 15, which are required to be made, which we all need to look into. So again, the accounting policy was not provided for the employee benefits, and in many cases, the disclosures under para 120 of AS 15 are not given or partially given by the enterprises. So on AS 15, I would like to share something further also, that many times I've seen during the course of our review that what happens is that there is a non-provision of gratuity or there is a non-provision of leave encashment, and it is given in the notes to accounts, or many times it is given in the policy, but there is no mention in the auditor's report. Let me tell you, friends, that see, this is in the auditor's report, it is given as an emphasis of matter, giving reference of that note number, and no qualification is given. See, unless it is not a material item. It would invite a qualification because it is a non-compliance with the accounting standard. And just by given in the emphasis of matter or in the notes to account somewhere, that does not absolve us as auditors to say that there is no qualification or modification in the auditor's report that is required. So in these case also that these, there were either the policy was not mentioned or there are disclosures with respect to gratuity, that what is the actual valuation, the gain, loss, all those requirements are there. You can go through any published account also to find the disclosures, though yes, under Ind AS the disclosures are far more than what is there under AS. So please do not do a copy paste from the Ind AS financials, because otherwise you will end up given more disclosures than what are actually required under the AS. But please ensure that under para 120 the disclosure requirements are met. On AS 16 now, borrowing costs. Note on secured loans as well as related information given in the notes to accounts. It reflects that certain borrowing costs have been included during the year and a portion of which was capitalized and the rest was expensed. Now, there is a requirement. So if you see that the company has capitalized a significant portion of financial charges, but the accounting policy was not disclosed. Like I said earlier also, that on borrowing costs, in this case, it is still worse off because there has been a capitalization of borrowing cost and still the policy is not mentioned. But please ensure that wherever there is a borrowing cost, the policy on borrowing cost should be given. So again, restructuring charges on AS 16, that the debt restructuring charges, ECBs, upfront fees, they were all capitalized. Or I would say they were written off over the tenure of the fresh loans taken for refinancing such debt. So let us say the entity already had a debt which was coming to close on this year. They take a fresh loan on that, and then there is a refinancing that happens. They pay off this debt, and the new loan is, let us say, for a further period of 5 years. So the upfront fees or whatever are the charges, that is spread over a period of 5 years. Now, if we look at AS 16, it does not give any leeway for these costs to be capitalized or be deferred over a period of time. All these have to be charged to the statement of P&L, right? So please ensure that all these charges, the upfront fees, the debt restructuring charges, all those are transferred to the P&L the year in which they are incurred or where they are paid. Capitalization of borrowing cost to inventories. So again, a very rare situation, but in many cases, especially in case of real estate or where the inventory takes more than 12 months of time to bring to its location and condition, intended location and condition, capitalization of borrowing cost is permitted. So the policy that was given was that finished goods are valued at lower of cost or NRV. Cost includes depreciation, interest excluding interest on discounting of bills, and direct expenses to the point of stocking, etc. Blah blah blah. So if we look, that interest was included in the cost of inventories, but under AS2 the interest and borrowing costs are generally not included unless they relate to bringing it to the present condition. Now, in this case, what was the case was that the nature of business was such that it would not take more than 12 months for the inventory to bring it to its present location and condition. And then also the interest capitalization was there. That it is not in all cases of inventories that the capitalization is permitted or can be permitted. It is only where it takes more than 12 months, and therefore we have to sync AS2 with AS 16 for this purposes. So again on borrowing costs, the point on time till the borrowing cost, till what point in time the borrowing cost can be capitalized. So the policy that we observed in this case by the board was that till the date the asset is put to use. Now, friends, put to use concept is there under income tax. It is not there under accounting standards. So we have to be very clear about what is the cutoff date, because that would impact your profitability. And in most of the cases, like I have been saying, it would impact the true and fair view of the financial statements and your opinion also. So normally, as per the standard, the asset, once it is ready for its intended use, when the physical construction or production is complete, the cessation of borrowing cost would happen. That would be the cutoff by which only till that time the borrowing cost can be capitalized. Once it is ready for the intended use, after that the borrowing cost has to be charged off to P&L. So it is not the date put to use. There might be a difference between the date it is ready and the date it is put to use. So as per AS 16, only till the date it is ready that it can be capitalized. Segment reporting. So financial statements, I know it would be in very few companies that the segment reporting would be applicable, but just a few observations by the board that was there, that they neither contain any accounting policy nor any segmental information. So whether even if there is a single business segment or a single geographical segment that has to come up in the notes to account, you may not give all the disclosures, but at least that one sentence that the company operates in such and such business and has a single business segment or a single geographical segment, that must be coming either by way of policy or through the notes. So it was missing in many cases. Again, there were significant differences of the figures of net profit after tax, total assets, and total liabilities as reported in the financial statements as against what was reported in the segment. So you have segment 1, segment 2, and then you have the others category. So the summation of these three should match with the numbers that are being given in the profit and loss account, because in the others would be the residual category. So in many cases, we found that there were differences between this segment reporting totals and the amounts that were given with that has been given in the statement of P&L or in the financial statements with respect to assets, liabilities, profits. So one of the notes to accounts, it states that the company is primarily engaged in the segment of iron and steel products, and there are no reportable segments under AS 15. Now the notes on sales states that the sales comprise of both export and domestic sales, which was significant. So the observation here was that both the export and domestic sales were significant in excess of the 10% threshold. And it was viewed that the risk and returns would impact, because domestic risk and returns and the export risk and return would be different, and therefore there were presence of a geographical segment. Necessary disclosures were required, were expected to be given, which were not given in this particular case, right? So you can't just say that even though exports are significant, domestic are significant, you will have to understand whether there are different risk and reward and then make necessary disclosures under segment. Related party, again a gray area, a lot of observations on the related party transactions, because what happens, these are additional disclosures and it's important and pertinent to map that with the amounts that are being disclosed. So I'll go through one by one. So certain transactions have been reported with X. So that entity had reported transaction with X, but there was no disclosure of the description of the relationship with X. Now, if we look at the related party disclosure, there are two parts to it. One is the list of the related parties and the nature of relationship. And second, what we give as part of the table with respect to the transactions and the closing balances with respect to the related parties. So in the transactions table, there were transactions with X. However, when we look at the upper first section of the RPT disclosure, the related party name and the relationship was missing. So please ensure that you map both the part of the disclosures. Non-compliances relating to key management personnel. So here the managing director or the whole-time directors have not been identified as KMP, because please go through the definition of KMP, that those who take active part in the decision making, they would be the KMP. So typically managing director, whole-time directors, they would be KMP, and therefore their remuneration and other transactions have not been disclosed. The COO has been reported as KMP, but the CEO was not reported as KMP, right? So again, this was an observation that it is very difficult to digest that the CEO who takes all the executive decisions is not a related party or a KMP as a related party. Again, the transactions with the KMP have not been disclosed under related party disclosure unless only the reference to the note on managerial remuneration. So you have the note on managerial remuneration where the calculation and everything is given. So in this case, it was just said that you refer to that note and what was the actual amount that is paid to the KMP, because name-wise details also at times have to be disclosed. That was missing in some cases. Under related party disclosures, transactions of similar nature along with values thereof have been disclosed on an aggregate basis against each type of related party. So the requirement of the standard is that for any nature of transaction, if 10% or more is with a single party, then that name of the party also has to be given in that table, right? So what was seen was that only general, let us say rent paid, and you have the full amount. You have the category that holding company, directors, KMP, whatever is there, and then that full amount is given. Though it was also noticed that in certain cases, more than 10% was given to an individual party, that separate names were not mentioned, which is the requirement of the standard. Name of the related party, improper disclosures, are very generic terms are given, not the correct technical terms. So what we use in the day-to-day parlance, that is what was given: common director, affiliates, lesser, other related parties, rather than using a very clear-cut, I would say, identification or the relationship of the related party with the entity, that was missing. Non-disclosure of related party transactions, again, these were missed out, like application money received from KMP for preferential allotment. This was not given as part of the disclosures. Equity shares allotted to KMP on conversion of warrants, dividend paid to holding company, loans and advances given to as well as repaid by subsidiary. So what happens is many of these transactions gets missed out from being reported, whereas in the Schedule 3 financial statements, in the director's report, in other compliances, these do get reflected. And when that mapping is done, it is found that there is a deficiency of disclosures as far as AS 18 is concerned. Only the volume of transactions with the related parties. So you have the transactions again in the transaction table. There are two parts. One is transactions during the year, and the second is the amount outstanding as at the balance sheet date. That should also be disclosed. So in certain cases, we've seen just the transactions during the year getting reflected. The closing balance as or outstanding balance as at the balance sheet date was not disclosed in these cases. Moving on, AS 19 leases. I know we have just about 5 minutes, so I'll quickly cover through the remaining standards. No disclosures are provided regarding leases. So again, there are specific disclosures which are there for the lease rental under AS 19. So neither the policy was disclosed nor the other requirements of disclosures that were made under AS 19. So please go through all these standards, friends, that there are some specific disclosures under each standard other than the significant accounting policy which are required, and kindly ensure that you adhere to that. On the EPS, again, quickly, on the face, only earning per share was disclosed without stating whether it is basic or diluted EPS. Both basic and diluted EPS have to be disclosed. If it's the same, you can say earnings per share into bracket basic and diluted, but that specific disclosure that both have been disclosed has to appear on the financial statements. Share application pending allotment was disclosed, but the diluted EPS was same as the basic EPS, which means that there was no cognizance that was taken for the dilutive EPS. The number of shares should have been increased by the share application money that were to be allotted into shares. So typically diluted EPS would be less than your basic EPS. It cannot be same when you have such outstanding balances. Both diluted and basic were reported as nil because the company had incurred losses. That is not the right way. You cannot show at nil. You have to show negative earnings per share when the company incurs losses, basic as well as diluted. It cannot be shown as nil under AS 20. The diluted has been stated as not applicable. Again, similar case that there were diluted potential equity shares and which were ignored for the purpose of calculating the diluted EPS. The number of outstanding equity shares has increased compared to the previous balance sheet date. So the weighted average number of equity shares was not considered in this case. It was taken for the full year because the number of shares, when you calculate the EPS based on the profit divided by the number of shares for the shares which were increased during the year, it was the full year and the weighted average was not considered, and therefore it means that the EPS had been wrongly considered or wrongly, I would say, disclosed. Accounting for taxes on income, AS 22. certain companies do not disclose the breakup of deferred tax liability, deferred tax asset in the financial statement. So you have to give that under, timing differences, what are the differences that are there. Like typically, I would say that we would have something around a 48(3) or a 48(2)(b) disallowances for gratuity leave, and some on account of because of the property, plant, equipment, fixed assets, the deferred tax asset liability. So those major line items have to be disclosed, and which would be the breakup of the deferred tax asset and the deferred tax liability. Again, on the deferred tax liability and asset are recognized subject to consideration of prudence on timing differences. So it is just the deferred tax asset to which this applies, not the deferred tax liability. If you read the sentence, it comes as if even for deferred tax liability, there was a consideration of prudence, which is not allowed as per AS 22. For all deferred tax liabilities, they have to be recognized, and it is only for asset that the prudence is applicable. On the carry forward of losses and its accounting policies with deferred tax asset, the management is of the opinion that sufficient future taxable income will be available against which such deferred tax asset will be realized. Again, there are unabsorbed losses, but it has not been stated whether there is a virtual certainty supported by convincing evidence that such income will be available. This is a very generic statement that has been given in the financial statements, and it is not in compliance with the AS 22. So again, where to disclose the deferred tax asset or the liability on the face of the balance sheet? Now, there is a clarity which is there that it should be disclosed on the face if it is a liability after the head unsecured loan, and if it is a deferred tax asset, then on the face of the balance sheet after the head investments. But if you see, we've seen such disclosures being all over the place on the face of the financial statement. So please ensure that the DTA or DTL is disclosed at the right place in the financial statements, being it an asset or a liability. On intangible assets, deferred revenue expenditure, friends, after AS 26 has been revised, there is no such concept of a deferred revenue expenditure. It was there 20 years back, I would say, when company was incorporated, and over 5 years, the deferred revenue expenditure and incorporation expenses and all were being considered. So now there is nothing like a concept of deferred revenue expenditure, and only if there is a future benefit that can be seen that it can be capitalized, otherwise it has to be charged off to P&L. So we have seen that factory license fees, trademark fees, seed marketing fees, public capital issue expenses, preliminary expenses, rent paid for pre-commencement of retail stores, factories, all these have been treated as deferred revenue expenditure, which is incorrect. These are all to be expensed off. There is no concept of deferred revenue expenditure now. On intangible asset, technical know-how is amortized over the useful life of the underlying plant, and amortization done on a straight line basis. But if you see what is the period of the amortization is nowhere mentioned in the policy. And this, as per the requirement, you have to mention the period also, that useful life of the underlying. Yes, but what is the useful life? Because maximum under AS 26 intangible you can take is 10 years. So whether this is within 10 years or beyond 10 years, nothing was clear, and therefore this is a non-compliance. Accounting policy on research and development states that the expenditure on proposed projects has been accumulated and it has amortized over a period of 5 years. So we all know that research expenses cannot be capitalized. They have to be charged off to P&L, and only development expenses, subject to the conditions being met in AS 26, that they can be capitalized and amortized. So such general policy of research and development has been accumulated is technically incorrect, because research expenses cannot be capitalized at all. Moving on, last couple of slides on AS 29, contingent liabilities have been disclosed. So claim against the company not acknowledged as debts. There were amounts that were given, but the description of this, what is the nature of this contingent liability that should have been mentioned as per the requirement of the standard, was not mentioned, and therefore that was found to be non-compliant with the standard. The company has not provided for interest. So interest has not been provided on, I would say, bank loans or whatever, anticipating favorable outcome in respect of ongoing negotiations. On this anticipation, you cannot just take a call that interest I would not provide. Interest has to be provided as per AS 29, and even considering the prudence, principles of prudence, interest has to be provided till the favorable outcome is available in writing with your client. Till that point in time, interest has to be provided. And if it is not provided, again, like I said earlier, it would impact the true and fair view of the financial statements because profits are overstated or losses are understated. And finally, provision for expense and provision for capital goods have been disclosed under the notes on other provisions. Going back on this, friends, on this, I would just like to share one thing, which is a very common mistake or non-compliance, is the difference between a provision and a liability. See, what happens is that the client has this tendency that wherever in the ledger the word provision is there, they would classify as provision and everything else is a liability. So provision for audit fees is a provision for electricity expense is a provision for telephone expense is a provision for bonus is a provision. Technically 100% incorrect. Please go through AS 29 where they have a full paragraph given about what is a accrual, what is a liability, and what is a provision. Right. So there is a difference that just keep this in mind that wherever there is a high degree of estimation that is required, that is a provision. Otherwise, it is a liability. So all these audit fees, bonus, expense payable, all these are liabilities, current liabilities, and not provisions, because once you classify anything as provision, the standard also requires that you have to show the full movement during the year of each and every item of provision, that is opening balance, amount incurred during the year, amount reversed during the year, additional provision created during the year, and closing balance. So whatever comes under provision, these disclosures are also mandatory. So please go through that paragraph and please ensure that whatever is in provision, like you have a provision for warranty, you have a provision for decommissioning, you have, so where there is a high degree of estimation that is required, that is where the provision would come. Otherwise, it would be a liability. So with that, I would, I have, yes, it's time to close now. And in case there are any questions and we have time for responding to them, I would be happy to take them. Over to you, Payal. So thanks everyone for a very patient listening. I know I'm running into your lunch time now and my lunch time also. So yeah, thanks everyone.
Thank you, sir. Thank you for the guidance. And certainly, it is very helpful for us while we are practicing. Sir, I've been asked by the members to kindly share the PPT for the whole members. That's the only question which have been
So
there for me.
PPT, most probably in the next week, what we'll be doing is portal, because these are the standard PPTs that we use across to create awareness amongst members. So we'll upload on the FRRB portal. And like I said, these are all forming part of those publications. We have taken the questions and the observations from the publications of the FRRB. So these are just a sample of them. And I would urge all members to please download them and go through the other non-compliances also, which are there in those publications.
Yeah, sir. That's the question. That's the demand which members arose, that the PPT should be shared.
Sure. Thank you.
Thank you, sir.
Thank you. Thank you very much. Thanks.
Thank you, sir. Thank you, sir.
Thank you so much, sir.
Thanks everyone.
CP